everyone, welcome back to my channel. So today's video is going to be a breakdown of one of the tabs here in Thinkorswim that often gets overlooked. So it's not hidden, but it is underneath the option chain, so you may find yourself skipping over it, but I definitely want to take some time and provide some detail about this particular tab. So y'all can see here, this is typically what it defaults to look like once you click under the Trade tab, but I'm going to go ahead and collapse this weekly for January 10th. And now you'll see underneath the option chain, you see it says today's option statistics, it says options time and sales, and then it says product depth. Today I'm going to go ahead and focus on today's option statistics. I'm going to hit the drop down. Eventually I'll make videos about these two other tabs, but I want to spend a bit of time talking about this particular tab first. So let's go ahead and start here on the left side. We'll then break it down in the middle, and then I'll discuss everything on the right side. So the first thing we see here at the top is going to be the 52-week high implied volatility, and this is the highest IV level the option has reached in the past year, indicating periods of greater participation, uncertainty, or potential price swings. And then underneath that, we see the 52-week low IV, and this is the lowest implied volatility during the same period, reflecting a bit more stable market conditions or lower expected movement. Now, both metrics help traders determine if the current implied volatility is relatively high or low compared to past levels. And then moving on, underneath that, you're going to see it says current IV percentile. Now, a good implied volatility percentile, it really depends on your strategy. Anything above 50% indicates implied volatility is relatively high compared to the past year, and this is ideal for selling options to collect higher premiums. Now, anything below 50% implies that volatility is low, which may favor buying options as they're cheaper. Now, generally, an IV percentile above 70 is excellent for selling, while below 30 is optimal for buying. And now underneath that, we see the 52-week high for the historical volatility. Now, this is something a little bit different from implied volatility, but not too far off. The historical volatility is going to be relatively similar, and this is telling the highest actual price movement observed over the past year, showing the most volatile period. And then, of course, opposite to that is going to be the 52-week low historical volatility. And this is the lowest indicated price movement, reflecting the most stable period in the last year. Now, these metrics help assess how volatile the stock has been historically, so that's good information to know. Now, moving on, you see, of course, we have the standard implied volatility. This is just going to tell you what it is for this particular trading day. So, of course, we're looking at Google, and you guys can see here, it's going to be at a 35%. Underneath that, you see VWAP. Now, for anyone unaware, VWAP is simply the volume-weighted average price, and this is just simply a benchmark that shows the average price of a stock based on both volume and price throughout the trading day. So it basically helps you identify fair value and assess the trends. So prices above VWAP, they usually suggest bullish sentiment, and then prices that fall below indicate bearish sentiment. So I hope that makes sense. Okay, so now we're going to go ahead and take a look at this middle column here, and of course it's going to tell us the trade analysis at the top. Now they have this color coded for calls and for puts, and then they also give us a sum total right here on the right side as well. So let's go ahead and break each one of these rows down. So the first thing we see here is the total volume, and it's going to tell us under calls there were 122,969, and then for puts there were 45,930, and then it gives us a grand total of 168,899. So this is good to know as far as analyzing the charts and what's going on with price action as you're going throughout the trading day. Underneath that, we see traded at bid or below, and of course it's telling us it's 37,000 and then 13,000 for puts. And it gives us the total as well as far as the percentage. It looks like it's 30%, and then of course 29 for the puts. And then we see traded at ask or above. Again, 34,000 for calls, 15,000 for puts, and then the percentage total is 28 and 34. And those concepts are pretty self-explanatory because you guys know what the bid and the ask price is. Essentially, that's what you're paying for the cost of the premium. So moving on, we see between the market, it's at 51,073 and then 16,678 for puts, giving the percentage total at 41% for calls and then 36% for puts. And then on average, it's giving us that 40%. So now we see the delta between. Let me go ahead and break these ranges down so that it makes total sense to everyone. So within Thinkorswim, obviously we see here it says 0 to 20. And basically this refers to the sensitivity of an option's price and it's the changes to the underlying stock or ETF's price. So for anyone unaware, the delta measures the expected change in the options price for a $1 move. Now the scale typically ranges from 0 to 1 for calls, and then of course -1 to 0 for puts. But a delta ranging from 0 to 20, this basically is going to say a 0.20, if anyone's wondering. In decimal form, that's what this is, a 0.20. And this represents the out-of-the-money options with lower sensitivity to stock prices. So to interpret this, just think about it like this. The delta of 0 to 20, these are deep out-of-the-money options with minimal movement compared to the underlying stock. And they offer lower risk, but they also offer less reward. So let me just put this plainly so that it makes sense for everyone. Essentially, this means the strike price is far from the current stock price, so the option has a lower probability of expiring in the money. And as a result, the price of these options is less sensitive to changes in the stock price as reflected with their lower delta values. Now, when we look at the delta between 21 and 40, this typically represents in-the-money options with moderate sensitivity to price changes in the underlying stock or ETF. Now, here's what this range really means. So since they're slightly in the money options, they reflect moderate sensitivity to stock price fluctuations, and in my opinion, it offers a decently balanced risk and reward. So this level is useful if you want more certainty in potential price movement without being too sensitive to small price swings. So basically what I'm saying is these options provide greater leverage than low delta options, while they still also limit the risk compared to higher ones. So for the most part, this delta range here from 21 to 40, it helps traders assess the potential profitability and risk of options as you're positioned closer to the stock's current market price. Now underneath that, we see the range of 41 to 60. This represents slightly average in the money options with higher reactions to price changes. Now with these options, they are more deeply in the money and a bit more significant for each $1 change. Now, because the sensitivity is a bit higher, there's greater exposure to the stock price momentum, and it offers greater potential gains, but also increased risk. And these higher delta options are typically better suited for traders expecting more substantial moves in the stock. Now, a delta from 61 to 80 here, this represents deeply in the money options, and it shows that the option price moves very significantly for each $1 move. So you can just about guarantee these options offer even higher potential reward, but they also, again, have a greater risk involved as well. And then last but not least is, of course, going to be the delta range from 81 to 100. These represent very deeply in the money, and they're often very close to expiration. So a delta in this range shows that the option price moves almost 1-for-1 with each $1 incremental move. And because of that, they're significantly increasing the risk of larger losses if the stock moves against you. The reason being is that they almost mimic the exact price of the stock. So it's good to know with this range, you'll take on higher risk for bigger gains. And generally, at the money or near expiration options often fall under this delta range. And really the last thing to note on this is that it helps evaluate the likelihood of rapid price changes. And let's say, for example, the risk to reward trade-off. So when you're dealing with highly leveraged or nearly exercised options, you'll see that for this particular range here. Okay, so moving on over here to the right side of the screen, we're going to start with the Sizzle Index. Now the Sizzle Index measures the relative trading activity of options compared to their average volume. A value above 1 is going to indicate higher than usual activity, which signals increased interest or potential volatility, while below 1 suggests lower than average activity. Now underneath this, you'll see the call and put Sizzle Index, both these right here. Now they sound exactly like what they are. The call sizzle compares the current call option volume to its average. It's highlighting unusual call buying or selling activity. And then the put sizzle does the same but for put options, showing if there's heightened activity in puts compared to the norm. And what's important here is that the values above 1 indicate elevated interest in either calls or puts. Now underneath that, we see the volatility sizzle. This is going to measure changes in implied volatility compared to the previous trading day. And a value above 1 shows a heightened increase in implied volatility, which means it signals increased market expectations for future price swings. And then underneath that, we see the stock sizzle. This is very similar to the volatility sizzle, but this compares a stock's current trading volume to its average volume. And a value above 1 leans towards higher than usual activity, suggesting increased interest or potential price movement as well. And then last but not least, of course, is going to be the PC ratio. Y'all know I made a whole dedicated video about this. So just the main takeaway is that the put to call ratio compares the trading volume of put options to call options. A ratio above 1 suggests more puts are being traded, often indicating bearish momentum, while below 1 suggests more call activity, signaling bullish momentum. So yeah, y'all, I just wanted to make this video to break the concepts under this tab down, just for anyone who may need the information. Like I said, oftentimes this particular tab gets overlooked, so I just wanted to make sure everyone kind of had a full breakdown and understanding what they have as far as references and resources here in Thinkorswim. Y'all feel free to let me know if this was helpful or if I provided any value to you to help you out with your trading. Yeah, so I hope y'all enjoyed the video. I thank y'all so much for watching. And of course, I'll see y'all in my next one.